investigate some key concepts in this chapter. The key concept to financial accounting are the accounting documents and parallel accounting. So the concepts are in the management accounting. There's accounting documents. There's several document types. In financial accounting documents or FI document records the impact of financial data of a transaction step on financial accounting. So financial accounting document consists of a header section and a detail, a line, or item. You can see over here. The header includes the data that apply to the entire document, such as document numbers or document type and various dates, company code, currency use, etc. A document type is a two-character code that identifies the specific business process step that generate in the document. Like we can see here, the commonly used document type include the customer invoice, or as DR, or customer payment, DC, and goods issue, WA, and goods receipt, WE. A document type determines the document number, range, and account type associated with the posting. A detailed section consists of two line items, a debit item and a credit item. Account types are the customer OD or the vendor K, asset A, material M, and general ledger accounts S. So samples of additional data are the cost centers and business areas. A posting keys is posting key the two digital that determines how a line item is posted, and the posting key specify the following: the account type for posting the document item, and whether the document item is posted as a debit or credit. A few status of additional data. Those there are samples of key posting key. Posting keys over here we can see. Number one, invoice, or we classify in the account type as customer, so classify into the debit. The posting key 1.5 is a payment or credit, it's account type as customer. 1.3.1 invoice, credit is account type for the vendor. For the parallel accounting, as we know that a general ledger is based on the operating chart of accounts. So an organization can implement multiple ledgers in parallel and use each ledger for different purposes. This practice is called parallel accounting. An enterprise will implement a set of accounting principles for all companies by company codes, and in the enterprise we call the client, and the global principles are consolidated in a single ledger known as a leading ledger. So a leading ledger is required and all transaction data are posted to it. The enterprise will define the non-leading ledgers for each company, a company code, based on the local accounting practices. For example, in the US or in German, there are differences. GPI has implemented the leading ledgers based on the GLOOCOI. It shows how parallel accounting would be implemented within the GPI and should the enterprise choose to do at a later date. So in addition to the leading ledger, each of the two other companies in the corporation GPIs had the non-leading ledgers based on the local accounting standards. And GPI used the leading ledger to consolidate its financial statements for global enterprise and the non-leading ledgers to meet the local reporting requirements in the US and in Germany. And next, we investigate about some concepts in management accounting. A key function of management accounting is to manage and allocate costs in a company. And companies incur these costs as they carry out the various business processes. For example, the fulfillment process involves the costs related to selling products and services, and the production process involves the costs associated with manufacturing products, and other costs include the supplies, maintenance, and equipment that are consumed by various processes. And the cost center is associated with the location where the costs occur. And the cost centers can be associated with the departments such as marketing and finance, with locations such as plants, and with individuals. A cost center is something that absorbs the costs that are generated by the companies when they execute the process. For example, when the company purchases supplies, it assigns the cost of the purchase to a cost center. If the marketing department purchases office supplies and the company is assigned in charge cost of the supplies to the marketing cost center, the company will review and allocate these accumulate costs, and think of the cost center as a container that accumulate costs. And the authorization to fill the customer order is a sales order, and the authorization to produce something is a production order. So these orders and cost centers are called cost objects. So we will discuss it in chapter 4, those terms in more details. About the processes. General ledger accounting is based on the double entry accounting system, where every transaction has both debit entry or the credit entry. So recall that the accounts are divided into the balance sheet accounts and the income or profit and loss statement accounts. So the balance sheet accounts are grouped into assets or liability, while profit and loss accounts are divided into revenues and expenses. So these figures shows how postings are debit and credit to these accounts using a T account. Debits are displayed on the left side of the T account, and the credits on the right side. An increase in an asset account or an expense account results in a debit posting, and the decrease results in a credit posting. Also, an increase in a revenue or liability results in a credit posting, whereas a decrease generates a debit posting. Consider the posting example number 1, investment in a company. A venture capitalist invests 50,000 USD in GBI US, and which GBI deposits into its bank account. The investor receives the GBI common stock at $1 per share. How is this transaction recorded in the general ledger? So the first step is to identify the relevant accounts. For this transaction is appropriate account at the bank, and we have the common stock over here, and they have their code here and their codes here. The transaction will generate an increase in both accounts because the bank account is considered an asset. There will be debit posting, while the common stock or liability will receive the credit posting. And let's consider to the next example. GPI purchases office supplies for 500 USD with a check. Office supplies are expense, so they are defined as money spent rather than treated as an asset upon purchase, even if some of the supplies remain unused. So in this case, the relevant accounts are the bank and the supplies expense. And next, we consider the scenario in where the GBI purchased 1,000 of office supplies, but on the credit rather than with cash. In this case, the purchase and payment are recorded separately. One account is supplies expense, which is debited by 1,000 USD. The offsetting account is payables miscellaneous, and which is credited by 1,000 USD. And the payment is made using the bank account. 1,000 in credit. And finally, payable miscellaneous accounts is clear. It's a 1,000 debit. This transaction is shown is clear in this figure. For the account payable accounting, the AP. In accounts payable accounting, the accounts payable subledger consists of individual vendor accounts. The subledger account number is created when the vendor master record is created. So the vendor master record and the vendor subledger account share the same account number. The associate the reconciliation account is a general ledger account. That's it, isn't it? It is a reconciliation account, and the accounts association between the vendor's account and the conciliation account is established in the definition of the vendor master record. So in the GBI general ledger account, the account numbers as 300, 300, 700 accounts are payable reconciliations, designated account. So let's consider a scenario in which GBI purchases office supplies from 3 vendors, vendor number 1, number 2, and number 3. Each vendor has designated vendor account numbers. That is also a subledger account number. The purchases are as follow: 1,000, 2,000 for the vendor 1, 2,000 USD for vendor 1, 1,000 USD from vendor 2, and 4,000 USD from vendor 3. GBI makes these purchases on the credit and then pays the vendors at a later date via check. We can see in this photo, and each purchase results in debit to the supplies expense account, to the credit to the appropriate vendor account. So posting to the vendor accounts are automatically posted to the reconciliation account, and accounts payable reconciliations as indicated by the rows. And the payments recorded in those steps results in the credit posting to the bank account and the debit posting to the appropriate vendor account. And again, these debit posting are also automatically made to the reconciliation account or account payable reconciliation, account receivable accounting, or accounts payable accounting is concerned with vendors. Accounts receivable accounting is concerned with the customers. When businesses need to track money owed by each customer separately, so they create an account in accounts receivable subledger for each customer. With the corresponding general ledger account, the customer subledger account is created when the customer master record is created, and they share the same account number. The association between the customer account and reconciliation account is established in the definition of the customer master record. You can see in this photo is the sample for the GBI, the reconciliation account is accounts receivable because it's with the number. The code number is 110 and 100. So in this scenario, the GBI sells bicycles to customers on credit for 5,000 and 3,000 USD, and then they receive the payments at a later date. These purchases is step 1 and 2, and the relevant accounts are sales revenues and the individual customer accounts. The sales revenue is credited by the amount of sale, and the corresponding debit is made to the appropriate customer account. This debit is also automatically posted to the accounts receivable reconciliation accounts. So in this case, the account payable reconciliation account and the account receivable reconciliation accounts does not track the details of the transaction. But when the payment is made, the bank is debited and the appropriate number account is credited. At the same time, a corresponding automatic credit is put into reconciliation account or accounts receivable reconciliation. Chapter 3. Please answer the following questions for reviewing your knowledge.